All right, guys, when it comes to what's going on in politics today, looks like even though the infrastructure bill is being negotiated, there are several things that are going on behind the scenes that we're going to discuss. For example, looks like millennials right now are focusing on retirement a lot earlier than most of us. Also, when it comes to the rich, we know that they pay very little in taxes, but most people don't know how they go about that. We're going to give you some details. Also, when it comes to the IRS, well, they're backlogged with your checks. Let's get started. Now, remember, the infrastructure bill is in two parts. The first part is the American Family Plan. The second part that they're voting on is the American Rescue Plan. One is focusing on the roads and the infrastructure and Wi-Fi. The other is focusing on families and social programs that need to be addressed. One is going to be with the Democrats and the Republicans working together. The other, which is the American Family Plan, well, the Democrats, they want to do that one all by themselves when it comes to the budget reconciliation, meaning that they won't need any help when it comes to needing Republican votes. Well, while all that is going on, the IRS is in the middle of being backlogged.
The pandemic caused the IRS to run at reduced capacity. Now you add to that a couple of rounds of stimulus payments, a distribution of a tax care credit payment for children, and new tax laws, and suddenly you've got a recipe for a backlog that is frustrating to those who want their refund. CPA Rob Davis is finding a significant number of clients frustrated waiting for refunds.
15 to 20% of the returns that have been filed, they haven't received those refunds. I suspect it might be even higher than those.
And that 20% delay is only for people who filed electronically. If you mailed it in, it's worse.
If you filed a paper return, you're looking at months before they'll even process the return because they're working still on backlogs of 2019 returns that were filed in 2020.
You can try calling the IRS, but only about 7% of callers are getting through, and it's not much better for tax preparers.
We have a separate line that we can call for tax practitioners, and we have about the same results of being able to get through.
That leaves online tools available via the IRS website. Go to the Get Refund Status tab. If you use this tool, be aware you'll have to give up some personal information, including your Social Security number as well as your filing status, married, single, etc., plus what you're owed. The IRS also has a mobile app which will do much the same thing. Now, these tools are updated nightly, and they'll show one of three messages: received, meaning it's there but unprocessed; approved, which means it has been processed; and sent, which means it's on its way by mail or direct deposit. There's also one other option.
You can go in and register to get a transcript of your tax return, but it only gives you a status, not exactly gives you an answer on it.
I've linked to how to get a transcript in my web story. Now, if you're still waiting, there is one bit of good news in all this because the IRS is holding it up, not you. The IRS will add interest to that refund when you finally get it.
The IRS is now sending out extra checks to those that have been unemployed last year and they got a tax refund or a rebate. The IRS is sending out child tax credits checks every month, at the same time trying to get the average tax refund checks out to you. And yes, there are many of you that are still waiting for your third stimulus checks.
So there are two different online tools you can use to track if money is heading your way. First, go to the IRS Stimulus Check Tracker. You're going to click on Get My Payment Tool. That will take you to a button which takes you to an online form, and the system will instantly tell you the payment status, such as if you're eligible or if money is on its way yet. If the IRS payment tracking tool is saying that it made your payment weeks ago and you haven't received it yet, or if you got a confirmation letter in the mail but not the actual money, you will be requesting a payment trace. It is Form 3911 taxpayer statement regarding refund. Let the IRS know if you suspect someone stole your check or if you accidentally threw your check in. That actually happened to a lot of folks in the first round of stimulus payments. People thought the debit card was junk mail. So if you lost your debit card, you may be able to request a replacement card. There's a phone number, 1-800-240-8100.
So when it comes to the IRS, they're asking you to do a few things. Make sure that your address and mailing information is updated if you're going to receive your check by mail. Also, make sure your direct deposit information is updated. You can also call the IRS to track your check. If you are waiting for a tax refund and you have not received your money, or you're still waiting for that third stimulus check or that extra funds that they're going to send to those that were on unemployment last year, or even your child tax credit, because now there are millions of individuals that still haven't received their first or second child tax credit check, you can reach out to the IRS, and the phone number is in the description of this video, and you can call them, not to ask them, where's my check, but ask them to put a tracker on your check. Once again, put a trace or a tracker on the check, because the check may have already been sent out or sent out to be deposited, and you just have not received that money. And speaking of money, as I mentioned before, the rich continue to get richer, and there's a reason why.
In 2018, Amazon famously pulled in over $232 billion in global revenue, and yet its federal tax bill was $0. And in fiscal year 2020, at least 55 of the largest corporations in America, including FedEx and Nike, also managed to pay no federal corporate income taxes.
There's a great Supreme Court case with Judge Hand going many years ago that it's not the taxpayer's responsibility to pay the most taxes that he can. It's the taxpayer's responsibility to pay the least taxes that he can.
So how exactly are the country's biggest earners using the tax code to avoid paying taxes? To understand how the wealthy take advantage of the tax code, you first have to look at where all that wealth comes from.
The biggest loopholes arise when you have assets. Most Americans don't have assets. All they are depending upon is their income from their salary from their employer. So if you have someone who has assets such as business and real estate, again, they are unlocking different areas of the tax code that most individuals do not get to explore.
You can think of someone's wealth as being comprised of separate assets which fit into one of three different tax buckets: taxable, tax deferred, and tax-free.
If your only form of income is your annual salary, then all of your wealth just fits into the taxable bucket. But the rich also tend to diversify into other types of assets and investments that the tax code doesn't consider to be taxable income. There are individual retirement accounts, some of which are not subject to federal taxes, and then you have investments like stocks that fit into the tax-deferred bucket. If the value of your stock portfolio goes up, you don't owe tax on those gains until you realize that gain, aka not until you sell that stock. And even when you do sell, the tax rate is typically lower than the rates on wage income.
Capital gains can be avoided in life and also largely avoided in death. And so that's highly advantageous to high income, high wealth people.
Capital gains taxes also apply to bonds plus tangible assets. So think things like real estate or cars and boats. And with the right tax planning, you can time it such that you only realize those gains during a fiscal year when you have big capital losses to offset that gain. You can also skip the tax entirely if you pass that appreciated portfolio onto your heir when you die. Plus, owning property opens up higher earners to even more ways to chop down their tax bill.
If you own real estate, you can now deduct things as depreciation, real estate taxes, property taxes. Even if you are not investing in real estate to get rental income, even if it's your primary residence, you can itemize your tax deductions on a Schedule A, which can also lowerly affect your tax liability. On the other hand, if you do have rental properties, you can take advantage of depreciation, your expenses related to your real estate property, and earn some extra income while paying minimal tax on that additional income that you are earning.
And these strategies are just the tip of the iceberg. There's a whole patchwork of ways to drive down that annual tax bill.
There's not some magic deduction or magic credit that people overlook, and once I tell you, you're going to get a $10,000 refund. What there is a myriad of rules, opportunities, and options to lower your taxes. I'll give you a simple example. There's almost 12 different tax breaks for higher education, whether it be the tuition and fees deduction 529 plans where you can put money in an account and have it grow tax-free.
Borrowing against the value of real estate or borrowing against the value of insurance policies. For example, you can take out a life insurance policy with a high cash dividend and then borrow against that from a bank. The bank sees that as an actual asset, may loan up to 90% of the value of that life insurance policy. That loan is effectively income to you, but in the tax code, it's not considered income or a capital gain. So it's tax-free. So there's these kinds of techniques that can be used if you have a lot of income and a lot of assets that are just not available to ordinary people that don't have that kind of disposable income.
Those sophisticated tax strategies that we just talked about, they are all totally legal ways to avoid paying more taxes than you absolutely must.
Tax avoidance, on the other hand, is utilizing the tax code to benefit you in the way that is legal. So if there is a deduction for you having a dependent or you being able to expense something through a business, as long as you're following the tax code and the guidelines, you can take these tax positions.
Thanks to lax enforcement by the IRS, tax avoidance by the top 1% of taxpayers could exceed $5 trillion by 2029, according to former Treasury Secretary Lawrence Summers. This same report found that the top 1% account for about 70% of underreporting. So why is it that the country's top earners also tend to be pros in the arena of tax avoidance? Experts tell us a lot of it comes down to tax planning.
Wealthy individuals, tax plan. Most Americans don't have a tax plan. And a tax plan is going to encompass the CPA or tax accountant to go into the new stimulus package or new tax reform and actually look at how they can use the new changes in the code to benefit their clients. These wealthy individuals have that guidance throughout the year to get them to a more reasonable position by year end.
Therefore, as you can see, it is not a coincidence that the rich are not really worried about President Biden or Bernie Sanders when it comes to them having to pay their fair share of the infrastructure bill, at the same time putting money into the Social Security Trust. And there's a reason for that, because the rich know even if the government changes the percentage that they have to pay from 21% to 24 or 29%, the challenge of getting money from the rich is there are so many loopholes and benefits that the rich get that they normally pay little to no taxes, where we are expected to pay the bulk of the taxes here in our country. But when it comes to millennials, they aren't even focusing on just getting rich. They're focusing on retiring early.
The desire to quit working decades early is the focus of a growing movement, mostly among millennials, called FIRE, which stands for Financial Independence, Retire Early. How did he do it?
Saving a large percentage of my income was a big part of it. We saved about half of our incomes, and that increased as we made more money.
Living and working in Raleigh, North Carolina, McCurry and his wife never made more than $150,000 a year combined. After 10 years of saving and maxing out their 401ks, their investments, mostly in stock index funds, grew to $1.3 million. Will that be enough for him, his wife, and 3 kids?
You always have those doubts. Am I doing the right thing? Is this what I should be doing?
6 years later, the McCurrys say they live on just $40,000 a year, taken from his investments, and a blog he writes on the FIRE movement called Root of Good.
I do think it's easy to get caught up in the traditional retirement kind of definition, thinking that it has to mean that you either work or you don't. I think there's so much more gray area, and that each of us really can define for ourselves how much of a role we want work to play in our lives. And the book really helps people make that decision in a really intentional way, whether that's full early retirement or something in which you work some, or like I do, which is I do a lot of stuff that looks like work, but it's all projects that I feel passionate about that I do only for me and not for anyone else. I do think motivates you to save more and to make some different decisions that do help insulate you against those things. You might get divorced, and maybe a couple saved an amount that was good as a couple, but it's no longer enough if you have to split it in half. or healthcare costs are rising every year. That's something that we need to account for. There are a lot of things that I think you can be very clear-eyed about. It's just a matter of acknowledging those risks and not assuming like, oh, we'll just adapt as they come.
Now, as you can see, there's a reason why individuals are focusing on retiring early. Remember, we had lockdown last year. Everybody was in quarantine. That gave us a lot of time to think about what we really want to do with our futures. Do we want to actually wait until 62, 67, or 70 to receive the life that we deserve? Or do we want to focus on getting it a lot earlier? Well, millennials and even individuals in Generation X, such as myself, have decided that they want to retire a lot earlier. And what we mean by that is not retiring from working completely, but retiring for working the corporate structure, retiring for working for someone else and doing things that we enjoy doing, creating projects or services that would allow us to have the freedom of time that we deserve. At the same time, putting monies to the side, because we know no matter what happens, we're all getting older and we're all going to need money when it comes to taking care of our medical needs. In our next video, we're going to be discussing more of that free stateside citywide money that's available for rent, utilities, Wi-Fi, child care, at the same time, mortgage relief. We're going to be discussing more of that free money that's available